All right, man. Bismillah. All right, I just want to review price action. Ideally, this is start on these last three candles. This is a weekly chart. ES continuous contract. I just want to review predominantly this past week's price action, and part of that we have to kind of, I guess, touch on all of this because I'll be using this weekly gap here. This is so you can kind of see where we are here. So based on where price was, you can see the next swing high would be here. So let's document that. I'll use this price note so you can be aware of how much what the price was on that. So I would say buy side liquidity, you can say it's rated because it's been taken out already, right? By now it's been taken out, but whatever. Right. Then I want to highlight this this gap here, and I'm not going to necessarily label it yet because I'll explain that later shortly. All right, so you see how price on the week of Tuesday, January 2nd, the first was a holiday, so anyway, January 2nd is the start of this week here. Traded down into the halfway mark of this weekly fair value gap, which is consequent encroachment of the fair value gap, aka the midpoint, halfway point. Additionally, we can kind of see that we're going to be looking at this. You can kind of see like this is this would be the next target, because this that I highlighted is already rated with this candle here. So this candle and this candle took that out, and then it pulled back. So you can actually highlight this swing high, and prior to this week, this would have been also buy side liquidity. So you can actually say it's rated now, but whatever, wasn't rated at prior to the week, start of the week. So you can say that. So for this week, the target would have, if we were still bullish, then yes, the previous week's high and this high, relative equal highs, would have been the target. I'd like to put an eyeball on top of the target to the next target. But so yeah, so this is what we would have been watching as the next draw on liquidity. These relative equal highs here. If not, then this would have been this swing low here, would have been the target. If not, right? To kind of like finish filling this gap, or that's the swing low here. Let's turn it like a green, whatever. Right, that should reverse the colors, whatever. It doesn't matter, right? Doesn't matter right now. All right, so then from there I will drop down. You can literally like, you can technically like skip this time frame if you wanted to, and just go straight to the 4 hour. And you can see, right? You can see on this time frame here, price took out a swing high here. took out this swing high, then what is price looking for on this time frame? You would say price now is looking to take out a internal range liquidity. Took out external. Let's highlight that. So took out this swing high. Then I just highlighted the black trend line. Right. Traded above it. You have a break. You have a market structure shift here. Let's highlight that. Market structure shift. And that's so yeah, so we got a market structure shift here. So then you look for fair value gap that was formed in the process of breaking the market structure or the market structure shift. So from there you can actually have kind of determine 50% of the range. So I literally highlighted this and this swing high here, and that's where you got it. So I started from here, dragged it down to here, kind of pulled it over here so we can kind of see, and I'm eyeballing it, so it could be the prices on the side here may not be as accurate, and that's too big for me, but I just swallow it up for you can see and drop it back down to smaller font size. So here is your entry. You technically don't need to even worry about optimal trade entry here, and this would be your bearish this would be your bearish fair value gap, 61.8. So we're looking for a price to like retrace back above the 50%. So this is your, this would be your entry here, and we would target all these swing lows. And again, we kind of like mentioned that since price took out, this would be called yeah, external range liquidity. And after external, then we look for price action to take out an internal range liquidity. Internal range liquidity, and that would be this fair value gap here. All right, is inside the range. That's why internal range liquidity. So you can look at that. All right, so I'm gonna erase these two highlights here, and we can note this would be your internal range liquidity, and you kind of go IRL, right? And up here you kind of go ERL. So this is what's meant by those. So check out external. We look like, so you're gonna seek internal range liquidity on this time frame here. Here's your entry short. Again, this is all last week This is today. This is actually all the way over here. This entry is on the second at 2 o'clock in the morning. That's your London kill zone. It's your London kill zone. Is that silver bullet too? Whatever. So this here, what I was going to mention earlier, why I didn't annotate this weekly fair value gap, is that when I see another fair value gap in that range, I kind of keep resizing it till it matches up to that if we start by the daily, and this is still your weekly fair value gap here, and I would stop on the daily and I would readjust this weekly fair value gap to match up with this daily fair value gap. That's what I would do. And then I would continue going down into the 4 hour, and then I would readjust it again, and that's what would coincide with this current 4 hour fair value gap. So that's what I would do, and then you can always so if it was no fair value gap here, then you just kind of default to the highest one, which would be the daily in this case. In this case, there's one on the 4 hour, so this is where I stop at. So yeah. So this would be your entry on this time frame. That would be your entry. You can even you can fine tune this as well. Just use the bodies of the candles. So just using the bodies of the candles we have, and I'll highlight what part of the candles. So I use this body of this candle, and then I use the body of this candle here, right? And still, optimal trade entry 61.8, and you can see 48.2775, and the high of this candle with the straight line and 2 o'clock on January 2nd is 48.28. So it's only a tick away, right? Anyway, I eyeballed it so it could be a little off, but whatever. This is pretty much a clean entry, and it's a 4 hour time frame, so we have several days trade here going on. So that's the 2nd, and that ends pretty much on the 5th. So get in on the Tuesday, and you could exit anytime along here. You could exit it here on the 4th of Thursday on the 4th. Looks like you had another entry around here because you have a fair value gap here as well. Right, so have a fair value gap here. Am I tripping? Did I make it too big? I made it too big, right? Anyways, too big. All right, there you go. Yeah, there's a fair value gap here as well. But so I love these because this is technically a bearish fair value gap. So normally I highlight this red. So here is bearish. Right here, right over here, price just totally disrespected this bearish fair value gap. And then use it as support. And again, use it as support right here. Right? So I wouldn't even highlight that I wouldn't keep it green. I wouldn't highlight it red, even though here it would be red. What I mean by here, right over here, I'll keep it as red because it's bearish here, but price use it as support, which is now technically a inverted fair value gap. An inverted fair value gap, as ICT describes, indicates a change in the state of delivery. So indicates that price action is no longer bearish, it's now bullish, right? So anyway, but that's a sweet run, right? This is 4 standard deviations from, just messed that up. Yeah, all right. 4 standard deviations from the price range that we identified with these 2 circles. So that's a beautiful trade. Short on the 4 hours. We can actually drop down further. But we don't have to, right? Here we have, let's delete this now. And using the same concept, took out internal range liquidity. We want to see where's the next external range liquidity. That's up here. That's this right here. You can kind of keep using. So clearly it took that out. You have a stop run. You have this would be your turtle soup pattern. Price running out liquidity. You can also say you have your 1, 2, 3 pattern here. Your 3 drives pattern. 2, 3. One, 2, 3. Then you have a higher high. Apologies, a higher low forming. First off, we have price running above this bearish fair value gap. After this 3 drives pattern, indicating that sell side liquidity has been taken, and you can kind of get into that. This can be your entry here, 2 a.m. and these are 4-hour candles. So when you say 2 a.m. is really like, right, you can fine tune it on a lower time frame. On this time frame, it would be at 2 o'clock, because that's the time that it opened. Closed at 6 o'clock, right? So yeah, you can either get in here. You can get in here technically. 3 drives pattern. You can see price kind of trade back above the previous candle's low, and kind of held above it as well. Yeah, so that being said, you can look for your optimal trade entry like I would like to. That's what I started out with the OTE entries. So I anchored it from that low to this high. And then you have entry. Come on. You have entry in the 61.8. You can see that right here. And that's your entry right here at 2 o'clock on the Monday the 8th, right? All right. So again, we targeting this external range liquidity here. And you have a lot of opportunities. Yep, a lot of opportunities here. And again, here's your run up. It was that bearish fair value gap that was violated, turns into an inverted fair value gap. Then you have a failure to go higher. You see this bearish fair value gap that we highlighted earlier is still valid. It was violated. There was a closure above it. Still not enough, right? Right, closure above it, but we still seeking this as a potential target. Okay, so this is the range. So we have a pullback here. You can still use this low because price is currently in this range here. So we're looking for price to go back below 50%. So it's this range to that range. Here's your below 50%. And you can either continue to use this, then back here, or you can use this fair value gap here, or this one. Bam, right? I think that green. This is why sometimes it looks like pink or whatever when I use the red, because it's like all right, so this is 4 hours. Have a fair value gap. Technically have a market structure shift. Here you can kind of this would be a better one here. This is good. It never stopped you out because your stop would be at the zero line. So you're not clear. It's not clear. This looks like possibly this was news. Long wick down. But here you go. So, and this is a better entry here. Pull down. Again, below 50% of the range. And there's your entry. Fair value gap. Long. And again, you can fine tune that to just the bodies of the candles. And you can fine tune it again because you can say you don't necessarily have to use this low. You can use this low because this is where the most dynamic price action occurred. So you can use that swing low. Now you have a steeper entry, reducing your amount of risk. All right. And you have your first scaling out here. You have your first take profit here. And this is the first time it took out these relative equal highs. Now price could continue on, or you can kind of look for price to pull back. Ideally below 50% of the range. There's a fair value gap here. There's a inverted fair value gap here. We do have these highs here as a level. So you kind of have like, all right, so right now is a breakout above the range, outside of the range. So you can have a pullback inside of the range, which what makes this a false breakout. And you will look for a fair value gap. Right now we have this one here. So you can literally have price pull back in and fill up this gap and then continue to the upside. Or you can have price violate this, kind of like feel it and trade below it, right? Because it took out a external range liquidity. So we're looking for price to trade into internal range liquidity. So right now I'm using this entire range, but you can see that this too is a range as well. So yeah, you can use that, but I would prefer this. That it's all about what you see. Trade what you see. All right, done. Kind of rushed through it. I feel like kind of skipped some things. This is my first recording, so whatever, right? Don't hold me. Don't hold me too tough, y'all. Any type of recommendations you have, please let me know. With that, subhanakallahumma wa bihamdika ashhadu an la ilaha illa anta astaghfiruka wa atubu ilayk.